Welcome to the Ellsworth Advisors monthly update for November 2024. I'm Kelly Keenan. This is Cameron Mealy, and today we will share with you the economic numbers for November and also how the market performed and how our portfolios did for the month and year to date, and also discuss what our thoughts are moving forward into the end of the year and beginning of next year. So Cam, why don't you start us off with some economic research?
Will do. Thank you, Kelly. Good morning, everybody. Let's jump into number we always talk about, GDP. On November 27th, the Bureau of Economic Analysis reported that according to its second estimate, GDP in the third quarter increased at an annualized rate of 2.8%. This was no change from the advanced rate, which was released in October. As you remember, second quarter GDP increased at an annualized rate of 3%, so still 3%, 2.8%. Very strong numbers for the U.S. economy. Looking forward, the Atlanta Fed's GDP Now forecast model, as of November 27th, the Atlanta Fed is forecasting that fourth quarter GDP will increase at an annualized rate at 2.7%. So again, very strong numbers out of the U.S. economy. Growth continues to be exceptional. The Fed meets December 17th and 18th, and at that point, we'll decide on latest trends in Fed policy, Fed's fund rate. A lot of economists still expecting a 25 basis point decrease in Fed funds rate. I think, that number is going to be predicated on a number of information that's come out. Let's jump into November jobs report. That will be reported this Friday, December 6th. The consensus estimate for new jobs, new non-farm payroll jobs in November is 200,000, with the unemployment rate remaining steady at 4.1%. As you will remember, the October jobs report was very disappointing, came in at 12,000 new jobs in October. That was significantly missing the consensus estimate of 112,500. Again, we talked about two major hurricanes, major port strike and strike at Boeing. Those didn't necessarily impact that number, but what it did was it impacted the reporting. So a lot of companies that were out of commission because of strikes or because of the hurricanes didn't report numbers accurately. So that number, you got to take it with a little bit of a grain of salt. Concerning the Fed, we always talk about inflation. That is their number one goal, is to keep the economy at about 2%, keep inflation rate about 2%. That is, their goal is to get inflation down to 2%. Personal Consumption Expenditure Index, this is the Fed's leading gauge of inflation. On November 27th, the Bureau of Economic Analysis reported that the Personal Consumption Expenditure Index increased 0.2% in the month of October. This was consistent with the 0.2% increase reported in September. And for the 12 months ending November, the index is up 2.3%. So this compares, pretty good trend, 2.7% in March and April, 2.6% in May, 2.4% in June, 2.5% in July, 2.3% in August, 2.1% in September, and now the 2.3% in October. So good trend. It's moving down, not the 2% they want it to be at, but moving in the right direction. The Producer Price Index. On November 14th, Bureau of Labor Statistics reported the Producer Price Index increased 0.2% in October. On a year-over-year basis, the index is up 2.4%. So again, we saw numbers as high as 9%, really during the height of the inflation bubble, and now things have come down pretty aggressively. The Consumer Price Index. On November 13th, the Bureau of Labor Statistics also reported the Consumer Price Index increased 0.2% in October. This was after falling 0.2% in September. On a year-over-year basis, the index is up 2.6%. So it does seem like inflation is coming under control, still not where the Fed wants to be, but is moving in the right direction. This kind of takes us into the question of what is the outlook for 2025. So two studies that I'd like to discuss. 2025 Outlook, this is by the National Association for Business Economics. They do a monthly survey, and their latest survey showing that economists have raised their growth projections substantially, they said substantially, for 2025, and no longer see downside risk as predominant. According to their latest survey, the consensus for GDP growth in 2025 increased 2% from 1.8%. And this, they cited, was following the election of Donald Trump as the 47th president of the United States. Highly touted report that a lot of economists focus on is the Goldman Sachs projection for GDP. Goldman Sachs is looking at U.S. GDP increasing to 2.5% annualized growth in 2025. And this is a quote from Goldman Sachs: "The world's largest economy is expected to grow faster than other developed markets for the third year in a row. The re-election of U.S. President Donald Trump is predicted to result in higher tariffs on China and on imported cars, much lower immigration, some fresh tax cuts, and regulatory easing. Goldman Sachs said the biggest risk across the board is the tariffs could hit growth hard if it's an overly aggressive policy. We don't know what that policy is going to look like, but certainly President Trump has touted use of tariffs to offset imported goods, from countries that use cheaper labor and sometimes don't play by the rules of international diplomacy, shall we say. So, we're looking at 2% growth, 2.5% growth in 2025. That'll be another strong year for the U.S. economy. Don't know how that's going to translate in the stock market. That obviously is going to, there could be a lot of macro and micro issues that pop up. Inflation is still going to be out there. Corporate earnings are obviously going to drive growth in the stock market. But right now, we're not really looking at a recession that we all thought was coming. We expected it to come. It looks like we're shooting for that kind of soft landing and a rebound and start growing again.
Yeah, the beginning of the year, most strategists, economists were expecting some kind of recession this year. Obviously, it didn't happen. GDP growth has been much stronger, and based on kind of where we're at now, nobody's really expecting a recession in the next 12 months. So the economy is growing, better than expected. High twos is a strong number, frankly. And, from an inflation standpoint, I think, where we're at now, we're kind of been hanging around that same spot, call it mid to high twos, from an inflationary standpoint, depending on how you want to measure it. But there is some concern that the tariffs could be inflationary. So, a lot of different theories out there, and, inflation, your tariffs could be inflationary. Reduced immigration can be inflationary. So there's a lot of different ways of looking at, potential ramifications of various policies. The bottom line is that, we're in a higher interest rate environment. Short-term interest rates, if the Fed reduces rates, they're working on short-term rates, not necessarily long-term rates. And it's really the long-term rates are more influenced by the longer-term inflationary outlook. And even though the Fed's going to be bringing down short-term rates, how much and how quickly, that's, a hotly debated question. Maybe they reduce once in December and then, various times throughout the year to get short-term rates, probably closer in that 3% range versus being the 4s where it's at now. The longer-term bonds, my thought is long-term bonds are probably where they're going to be, or, within a range between, 4.5%, 5.5%. We're right there just below 4.5%. So, if anything, there's some risk to upside from a longer-term rate standpoint. But in general, we're in a pretty good environment, and how that translates to the stock market. Stock market's always a forward-looking entity. And we had a great year in 2023. 24 shaping up to be as good as, maybe even slightly better. At the beginning of the year, when we look at how does that translate to clients' portfolios, even going into the year, my thoughts were, early this year that, 2024 would probably look a lot like 2023, and bar a major dislocation here this month, I think things are going to look pretty similar to last year, if not a little bit better. So that's good news for client portfolios.
Yeah, you can't argue with 15 to 20% growth.
No,
historical norms since the stock market crash, the Great Depression, it's been about 6 to 8%, depending on, what metric you want to look at, if dividends are reinvested. So we've had 2 years of really strong growth, and it's been fun, frankly, for everybody.
Yeah, it's made life a little bit easier. The market has changed the nature of the market. It's broadened out. So, a lot more stocks participating in the market, which is, participating in the upside. The larger cap, the largest companies, if anything, their growth has slowed down a little bit from a stock standpoint. And you're seeing, like I said, a broadening out of more participation from other stocks that are doing well. And you're starting to look at valuations levels that are definitely extended for the largest cap stocks, are getting pretty extended. So that's something we're keeping an eye on. We'll keep our toes in the water in those stocks, but we're definitely not overweighting at this point in time. For the month of November, The S&P was up strong, up 5.73%. The Dow Jones up 7.54, so we've seen a little bit of a leadership change there. For the longest period, the Dow Jones was lagging the S&P, but we're seeing some catch up. From that standpoint, Nasdaq up 6.21. Small cap stocks, great month for small caps, up 10.84. International stocks struggled a little bit. The MSCI EAFE, which is developed nations, was down slightly, down 0.74. Emerging markets down 3.66. Bonds, the bond aggregate, which is broad-based measure of bonds, generally a little bit more intermediate term, longer term, up 1.6. We did see interest rates come off their highs on the 10-year from above 4.5. Now we're around 4.2. So that's helped the longer term bonds. Year to date, the S&P 500 now up 26.47%. The Dow still still lagging a little bit, down 19.16. Nasdaq up 28.02. Small cap index Russell 2000 up 20.11, and the EAFE international markets up 3.56. Emerging markets up 5.36, and overall the aggregate bond index up 2.93.
That is an interesting dynamic concerning the international markets. We've been talking about for years how the U.S. has been the growth engine of the economy. We've said it over and over again that just because you read a book 25, 30 years ago that said you have to be diversified by having some international exposure, if international markets are not growing, you don't need that exposure. I mean, our portfolios have been heavily weighted in the U.S., and it's worked.
And that's so absolutely true. The U.S. has definitely been the place to be. More recently, you're hearing more pundits questioning the U.S. dominance of how long that will last. There's definitely been an overweight globally for money flowing into the U.S. So now investment in the U.S. is at as a percentage of overall global investments is hitting levels that we really haven't seen before in the past. So, we're in an interesting dynamic. Definitely talk of, is there a bubble, not just in, AI or tech, but even just a U.S. bubble. So, that's something, it's always in the back of my mind or the forefront of my mind. Either way, it's on my mind that, what's happening, are we overvalued or not? And you really never know. Overvaluation, you can't time overvaluations. At some point, they will tip, but you can be overvalued for a very long time and things keep chugging along. But so my thoughts, really the philosophy is, as long as you stick with, fundamentally sound companies, that will prevent a downside disaster or complete washout, because you always have the fundamentals to fall back on. You may miss some of the upside, but by sticking with strong fundamentals, that kind of adds that downside safety for you. And we're getting to, I think a point in the cycle, whether it's the market cycle or economic cycle, where we have to be very conscious of that. You don't, pull the horns in completely and, hey, it takes 2 years till the correction comes. Who knows? It could be 2 months, it could be 2 years, it could be 5 years. So, kind of stick with what we know is going to work regardless. In the growth of income portfolio, more of a balanced portfolio. In November, we were up 1%. Year to date, it's up 15%. Big gainers in November. Disney clipped off a 22% return. So welcome back to the game, Disney. Sony was up 14%. Honeywell up 14%. Visa up 9%. Really, Disney's been a laggard. Honeywell's been pretty much a little bit of a laggard year to date. So, making up good ground there. Laggards in November, Microchip was down 6.5, J&J down 3. Our real estate position was down 3%. Year to date, NVIDIA is still the big winner in this portfolio, up 180%. Iron Mountain up 81% for the year. Raytheon up 48%. Year to date, laggards, Nike still struggling, down 27%. We're off the lows, but they're working their way back. Microchip down 23 year to date, and Nucor down 10.3. Dividend yield, really, as the name implies, dividend focus. For the month, up 1.3%. Year to date, up 16%. For a pretty conservative portfolio, that's solid. Big gainers in November. Blackstone up 14%. Darden Restaurants up 10%. We just added that in October. Chevron up 10%. U.S. Bank up 10%. Laggards in November. Dow Chemical down 9%. LyondellBasell, another chemical company that we sold this month, down 4%. McDonald's down 11%. Is that fear of RFK? Who knows?
Make America Healthy Again starts Monday.
Yeah, bye-bye McDonald's. Year-to-date gainers, Blackstone up 50%, Packaging Corp up 56%, Caterpillar up 40%, Prudential, yeah, we got a good 30% gain out of that this year. Longer term, we've made a lot of money in there. We just happened to sell that recently, taking our gains and running. Laggards, really, year-to-date, we really don't have anything in the black or in the red year to date that we haven't walked away from. So, that portfolio has been solid. Appreciation with income, November, we're up 3%, year to date up 22%. So good returns there. November Energy Transfer Partners up 23%, Kinder Morgan up 15%. Both of those are energy plays. And then Bank of America up 14%, JP Morgan up 13%. So the banks have been doing well with, the interest rate environment is becoming much better for the banks. So I think we have, good things ahead for the banks. November laggards, AES, that got whacked pretty hard, down 20%. Vail was down 8%, Nestle down 8%, but we did walk away from Nestle. Year-to-date gainers, Energy Transfer Partners up 56%. General Digital up 38%, JP Morgan up 50%, Equitable up 48%. So obviously it's been a good year for financials. Laggards, Nestle down 23%. Like I said, we sold that last month, and then Bunge down 15%, which we also sold last month. Price potential, decent month, up 1.5%, trying to get things going in this portfolio. Year to date only up 4%, so it's been definitely a disappointing strategy. For the month, Markle was up 16%. Amazon, which we bought at the end of October, up 11.5%. Charles River Labs up 11.5%. Jazz Pharmaceutical up 11%. So some nice gainers there. Spartan Nash is still hurting us on the downside, down about 10% in November. Eli Lilly down about 4%. We just walked on that. And then Centene down 3.6%. Year to date in the portfolio that we're still hanging on to, Arch Capital up about 43%, Markle Group up about 26%. Laggards, most of the stocks that were underwater, we've gotten out of, a little bit of tax selling in there and just try to reposition the portfolio. Small caps, great month there, up 15% in November, year to date up 41%. So small caps, definitely have been hot. Big gainers in November, Graham Corp up only 60%. Kyndryl Holdings up 52%, IES Holdings up 42%, U.S. Live and Minerals up 36%. So obviously a lot of fireworks going on in that portfolio. On the downside, Zim Integrated Shipping only down 7.4%. International Seaway, which we did walk on, down 10%. Vital Farms down 4%. Year to date, big gainers, U.S. Live and Minerals up to 233%. IES Holdings up 291%. Graham Corp up 136%, Sterling up 121%, Northeast Bank up 78%. Year-to-date laggards, Transcat down 4%. That's pretty, that's the only one that's really down that we haven't walked away from. So in general, a good month. That's kind of where we stand. I think probably a little bit more upside between now and the end of the year. From a seasonality standpoint.
For a Santa Claus rally, as they say?
Well, I think technically that starts around Thanksgiving, so we're kind of in it. And, the momentum's at our back. You're going to have a lot of positioning. People that have been underweight, they're going to want to participate into the end of the year. So I look for a good finish to the end of the year, which, typically will bleed into January. And then we'll see how things are shaping up from an economic front and earnings front once we get into January.
So thank you, as always, for the trust you place in Ellsworth Advisors. If you have any questions, please feel free to reach out to us. We will talk to you again next year. So may you have a happy holiday season, a great new year, and we'll talk to you again in 2025.
Thanks. Happy holidays.